In today's video, I'm going to outline 8 dividend stocks that deliver me $660 each month. A year back, I created a similar video where my monthly dividends hovered near $508, so plenty has shifted, and I want to detail those updates today along with reviewing the 8 stocks. The dividend stocks within my holdings are what I refer to as sleep well at night stocks, or swan stocks briefly. They represent solid, reliable firms with a track record of distributing dividends, letting me earn passive income while I rest, which feels truly rewarding. Stock number 1 today is Procter & Gamble, or PG briefly. PG stands as one of the largest U.S. consumer goods firms around, and at this recording they offer a 2.76% dividend yield. That translates to roughly $4.23 yearly per share owned. A 2.76% yield might not appear elevated, but the benchmark S&P 500 carries a dividend yield around 1.17%, so it's notably stronger than the index benchmark. You'll notice that most secure dividend-paying stocks deliver between 2% to 4% yields, and occasionally a loftier yield isn't always superior, which we'll explore more later in this clip. Since last year, PG became a recent addition to my holdings for several key factors. First, it's a dividend king boasting 68 straight years of dividend hikes. Second, I believe stores like Target and Walmart face pressure this year amid elevated living expenses, persistent inflation, plus resumed student loan payments. Average shoppers will feel pinched on retail purchases. Procter & Gamble, though, markets essential items needed regardless of economic conditions. If we examine their brand lineup, it includes names like Bounty, Charmin, Head & Shoulders, Dawn, and many more. Finally, they maintain broad global reach plus variety across product categories, spanning 5 segments: beauty, grooming, healthcare, family and baby care, plus fabric and home care. Thus, owning PG resembles holding an index fund focused purely on consumer staples. Procter & Gamble is a massive name, sure, but an even larger one appears next, JP Chase. This is the second entry on my list, and I've owned it since last year's clip when it traded near $110 per share. That means it's climbed roughly 30–40% year to date, which feels remarkable. While we can't rely on such gains annually, we can depend on their dividend. Currently, it provides a 2.09% yield, equating to about $6.00 yearly per share owned. My primary reason for favoring JP Chase is their status as America's biggest bank, holding $495 billion in cash equivalents on the balance sheet, offering major reassurance to shareholders. This year's elevated interest rate setting hurt some businesses, but for JP Chase, it delivered advantages via higher net interest income, growing each quarter. I expect that trend to persist as the Fed indicated steady rates through late 2024 or into 2025. After smaller bank failures like Silicon Valley Bank, owning a robust giant like JP Morgan provides comfort and stability. It's among my top dividend contributors toward the $660 monthly passive flow. Before reaching stock number 3, I want to mention that Webull offers 6 to 12 free stocks upon signing up and depositing funds. It sounds generous, 6 to 12 free shares truly, but it's accurate. Webull serves as a trading platform for stocks, registered as a broker-dealer, and I use it to monitor my dividend positions. If the link remains in my description below, the offer stays live. I'm unsure of its duration, so act soon. It's among the strongest promotions available now. Stock number 3 is Home Depot, a personal favorite spot, especially for affordable fiddle leaf fig plants. I grabbed one lately. They distribute $9.20 dividend per share annually, yielding 2.66%. Home Depot leads as the top U.S. home improvement retailer, operating over 2,000 locations domestically with more than $154 billion revenue in the trailing year. Reviewing their revenue split from a popular site like Y-Charts, it spreads fairly evenly across categories. Interestingly, the indoor garden area drives the most revenue. Cheers to those fiddle leaf figs contributing. Another positive, Half their sales derive from pros versus half from DIY shoppers, so if one group slows, the other can support totals. With 33% gross margins and solid cash generation, it's a stable swan holding. Its rival, Lowe's, also merits praise as another home improvement leader. Both have surpassed the S&P 500 over the past decade. Few major competitors exist in this space, granting them a powerful economic moat similar to Google's dominance in search. Consistent traffic flows there. Another firm boasting a strong moat is Coca-Cola, beloved for its flagship soda, but also owning brands like Vitamin Water, Powerade, Fairlife, Smart Water, and Topo Chico. It yields 2.81% now, paying roughly $2.04 yearly per share. Coca-Cola's strengths include powerful branding, steady operations, 17% plus profit margins, and significant pricing leverage in inflationary times. Production costs rise, yet they can adjust prices without major demand drops. I hold Pepsi too, and both excel as staples needed regardless of economy, functioning much like consumer staples akin to Procter & Gamble discussed earlier. Notice many stocks here feature modest yields between 2% and 4%. As mentioned, yields of 10% plus often signal caution. If a company distributes that much, reinvestment capacity may suffer, limiting growth. Not every high yielder is poor, but yields above 5 to 7% warrant extra scrutiny and research. A stark contrast with tiny yields is Apple. It stayed in my portfolio from the start, yielding just 0.41% now. Yet as I steadily add shares with each paycheck, the dividends accumulate meaningfully, around 1.04 yearly per share. I nearly omitted it since it's not a classic dividend play, but it ranks among my largest monthly contributors. I primarily hold Apple for growth potential, with the dividend serving as a pleasant extra. Expect Apple to remain a global top 5 firm for decades ahead, bolstered by innovations like Apple Vision Pro and Watch Ultra 2. Services now comprise up to 25% of revenue, expanding steadily, including music, video, app store, etc. Another long-held dividend payer is AbbVie, ABBV, a biopharma firm with drugs spanning oncology, immunology, and neuroscience. It yields 3.04% currently, paying about $6.92 yearly per share. Last year's key event was Humira's patent expiration, their former top seller. Despite that, other drugs like Skyrizi and Rinvoq surged nearly 50% in sales. Analysts feared major financial hits, but AbbVie managed resiliently. Revenue and cash flow rose, $24 billion operating cash versus $22.9 billion prior. I include AbbVie for sector diversification as my sole pharma holding. Though flat this year, it's up about 9% over 12 months. It produces strong cash, but faces hurdles. Among today's picks, I'm most watchful here and will monitor coming quarters before deciding to retain or adjust. Next comes a familiar name, Kraft Heinz, KHC. They produce ketchup, A1, mustard, Kool-Aid, and more, yielding 6.52% now, around $160 yearly per share. With $26.45 billion net sales last year, it's no surprise Warren Buffett retains his stake. In 2019, he stated on CNBC he'd gladly hold it another decade. Kraft Heinz offers consumer staples in my view. Condiments rank essential since people eat constantly, even in tough times. It's among my weaker growth names here, profitable but limited appreciation potential. I'm not concerned about the dividend, but for bigger upside seekers, other picks might appeal more. It remains my smallest position, and if trends stay soft, I may exit in coming quarters. I have a bonus entry, stock 7.5, ticker VOO, the Vanguard S&P 500 ETF. It holds tiny portions of every S&P 500 stock and yields about 1.14%, paying roughly $7.07 per share annually, solid for broad diversification. Each paycheck, I allocate some to VOO2, adding a nice dividend perk to index investing. If individual stocks aren't your style, ETFs like VOO or Schwab's SCHD, a popular dividend equity fund, still provide yields. Our final stock today is Johnson & Johnson, another Warren Buffett favorite. It yields 2.35% now, distributing $5.20 yearly per share. It's a classic swan, offering essentials like Tylenol, Band-Aid, Listerine, Aveeno. A clear pattern emerges. I prefer stable firms thriving amid uncertainty. J&J boasts 61 consecutive dividend increases, earning dividend king status. Strong cash position ensures resilience even in severe downturns, making it a long-term keeper. So, how much capital generates $660 monthly in dividends? It's substantial. Assuming a 4% average yield, roughly $200,000 invested yields about $8,000 yearly, or $6,666 monthly. If that feels daunting, stay encouraged. I've built this over 12 plus years, investing consistently from each paycheck. The reality is, it requires patience, but watching dividends grow becomes incredibly satisfying. I hope you liked this overview. Claim those 612 free stocks via the link below while active, and watch my upcoming dividend video linked here or here. Thanks for viewing. Have an awesome day.